need to de-risk away from China for some portion of the imports from China. Both combination, makes us believe that, yeah, we are in a situation where the manufacturing-led growth is going to take over. Indian companies will cater to world or to our own customers by import substitution being the alternate word. And to that extent, the next round of enablers which requires a manufacturing creation, which is either infrastructure, either the core economy like, metals, oil, power. I think those things are more or less the macro picture in terms of, what sectors are going to drive the economy better.
So metals, oil, power are the spaces that
and manufacturing essentially, because manufacturing needs as a back support, right?
So manufacturing will be more to the tune of capital goods, the L&Ts of the world. Is
no,
that
actually,
the way to
manufacturing in a way is a very wide world, right? Pharma is also manufacturing certain things. Chemical is capital goods, equipment guys, as well as maybe FMCG, maybe auto. So manufacturing is a theme which India can export something, whether you can export a two-wheeler or or a phone or maybe chemicals. I think that's the macro theme of manufacturing across space. Capital goods are perhaps enablers to that, because you need to create manufacturing capacities in India, and that's where some of these cap good companies can come in to supply the equipments and get the projects on the ground.
Hi Krishna, good morning. Good to see you. When you have to give it to this government in the last 10 years or so, the way public sector companies have been looked at, PSUs, they have been looked at, they have been seen in better light. And the performance as well has improved out there. There's been a part of that re-rating that's taken place. Which are the themes you like from the public-owned companies as of now? The banks have done very well. You have defense stocks, you have railway-related names as well. What for you is top of the list?
Sure. So I think if you look at, again, PSU, incidentally, many PSUs are engaged in these core economic sectors. So you call it maybe, power, call it oil and gas, call it little bit of metals. They have a presence there. So that's a space which perhaps looks good. And the new theme, which is, which came up after the COVID really was a PLI and maybe Atmanirbhar through defense route. So defense is good. Infrastructure creation, logistics is perhaps, again, one more backbone required for manufacturing to really play out. Finally, let's look at some maybe a study of what happened to China. They also did all those right things of creating right set of ports and railway network and roads to finally enable a nice, exports capability. I think those things are, pretty much there.
The other area which we will see lots of players, lots of new IPOs, large ones actually, over the next couple of months. GoDigit in the insurance space is coming up with an IPO very soon.
Yeah.
A large player. In the context of Zomato, we were saying how Swiggy is going to come up with the issue.
Yeah.
We'll have I think Ola should be coming to the market, although I think they're waiting for the final approval from the regulator. How are you looking at some of these issuances, some of these large ones this year, Krishna? I mean, I'm assuming that, bankers come to you and kind of ask you to participate in the anchor book, etc. What's the view? How have you approached IPO so far?
Sure. So I think if you look at any IPO company, basically there will be two thoughts on one, what the underlying business right now, and second is what valuation, one looks at offering. So that's going to be the decision maker for each of these companies. But on a macro level, yeah, sometimes some of these IPOs are actually going to play a good role in both sides. One is capital availability to the right side of people, and second is some sort of easing of valuation, because net Indian market cap possibly goes up more because of the fresh listing. At the same time, the money needs to move from some existing sectors or stocks to some of these new companies. So that's where the rebalancing partly of valuations do happen, because finally, yeah, we need more investable companies in India, and that's going to help create a little bit comfort on valuations.
Okay. By the way, some stocks, since you're talking about the manufacturing theme, right? Just wanted to point out a couple of stocks. Hero MotoCorp is at a fresh 52-week high. That stock is now up about 20% this year, and it's come back in a big way after the recovery that we saw in its numbers, its earnings, and of course rural markets are also coming back. So Hero Motors at a fresh 52-week high. Couple of these other names, Havels is at a fresh 52-week high as well this morning. Polycab has been up and away. That stock is up 17% this year after having a phenomenal last couple of years. Polycab is the one I'm talking about. So Krishna, these spaces, right, within manufacturing, autos for example, looking pretty good. Most auto companies firing on all cylinders. Which are the pockets that you like here?
I think both passenger vehicles as well as two-wheelers are a nice sweet spot right now from a pure Indian market, let's say growth, and maybe over a little bit longer period, some of these companies can actually emerge as an export hub. because all these companies are trying to capture global customers and maybe auto anchors which are in a way derivative of some of this growth in auto industry. So broadly auto sector, positive, and it fits multiple themes: domestic consumption, export potential, both.
All right. What about the tech space? The verdict out there is split. Some are in favor of the large cap names, while some believe that the mid caps actually will outgrow the large cap names. So they rather, go with the mid cap names. How are you placed out there?
Yeah, sure. So if you look at IT right now, one of the challenge in IT is that you having a situation where the underlying customers which are in the developed markets essentially are not having a, great time on the growth front, or maybe the worries on, the incremental growth is there. So which is creating some pressure on customer spend. And by default, companies are currently under pressure in terms of the revenue growth rate. I think broadly, you do expect, typically large mid, in a way to be equal, because the valuations also are reflecting where, mid caps are far more valued than typical large cap IT companies.
Okay. Just one final question before we let you go. Any, any threat to this market, apart from elections? Of course, election verdict no one can predict, right? But apart from that, any threat to this market rally?
I think broadly, the risk sentiments for markets lies outside India.
Okay.
So what's happening to the global markets, notably maybe US and Japan's, central bank policies do matter to markets. So those, that's going to create that money supply or the liquidity or the demand for risk assets. Otherwise, the pure India market may be something which we all know. It is, the economy is good, but the route to participation through derivatives is a danger.
That you've highlighted before.
Yeah, so that's really the worry. Too many people focused on 1 month and 2 month view, and that's a risk factor. But that's a sentiment risk in the Indian markets rather than fundamental risk.
Okay, we'll let you go on that note. Thank you so much for being with
you.
us. Thanks for your time and being here in the studio. Well, for the market, it's not bad. To be honest, it's quiet. So after yesterday's recovery that we saw, at least we're holding on to our gains, 22,120. And if you look at the headline index, right, what's really leading from the front is commodities. JSW Steel, Hindalco, NTPC, Coal India are all your big gainers, ONGC, Reliance as well. And then you have autos. Hero is at a fresh 52-week high, as I said, and M&M is also up and about. But let's talk about MGL now. Their Q4 margins came in below street estimates. Gross margins are at a 5-quarter low. Volumes were in line though, but the revenue growth was flat while their net profits actually declined. Ashu Shingal, who is the MD of MGL, joins us now to discuss their Q4 earnings. Ashu, thanks a lot for joining in. Appreciate your time here. What led to this lower EBITDA per unit in Q4? It was at a 5-quarter low, I understand, and your operating expenses were also higher. And what is the steady state of EBITDA per unit that one can expect in FY25?
See, EBITDA has come down quarter last Q3 versus Q4, but if you compare last financial year versus this financial year, the EBITDA is higher. Last year it was at 9.4 rupees per SCM, and this year it is 13.9 rupees per SCM. So there is some growth in terms of EBITDA per SCM. However, the gas prices have stabilized. The prices have come down, and therefore the EBITDA has gone up. The gas cost procurement has come down. Therefore, the EBITDA margins have increased. And with respect to the volumes, we have gone up. And related to your query on the operating costs, we have launched certain schemes which has resulted into slightly higher operating costs this quarter.
Okay. So this EBITDA per SCM, right? You said in FY24 it was about 13.9. How much can you build on to it in FY25? What would the ballpark range be?
It's difficult to predict, but I think it will be slightly less than this number, because right now the market is very favorable to the conditions. And just for the records, we are selling the cheapest gas in the country, but the domestic gas is coming down. So therefore, the cost of procurement is expected to be slightly higher. And therefore, 11 to 13 rupees will be the correct range in which we expect FY25 to be the EBITDA range.
Okay, what I have is, I think on the call, Mr. Shingal, was that number 9 to 11?
No, 11 to 13, maybe 10 to 13 or in that range somewhere.
Okay, between 10 to 13 going forward is what you expect. And of course, I mean, if international gas prices start to come off sharply, as some are expecting, I mean, it'll change. The numbers will perhaps may look a little better.
I mean, the range, it's very big. 10 to 30 is a good range. So we expect if the numbers come down, the cost is already at a very low level. So we don't think that the gas cost will come further down. The other part is the domestic gas is coming down. So that will increase our procurement cost.
Yeah, no, absolutely. The APM share is off. On volumes, could you talk to us how, the 67%, I mean, what will this be led by? How will you do it? And what will need to be done to be able to achieve this?
See, it is divided into 2-3 sectors. One is the CNG, which is the main driver for the growth. So this year it was slightly subdued, but with the launches of many schemes which we have done the last quarter and this quarter, we expect the results to come in this financial year. Industry and commercial also, we are readying a lot of infrastructure in Raigad and Thane and other Navi Mumbai area. So some more industry and commercial are expected to come in. So that is the area where we think demand will pick up around 6 to 7%. This year we have clicked around 5.5% year-on-year growth on the volumes front.
All right. Hi, good morning, Mr. Shingal, and good to see you. And interesting that EBITDA per unit, it looks like a little bit higher than what the street was working with or they understood on the call. But we'll take that 10 to around 13 rupees. On the volumes, a couple of questions. How much are you factoring in from the Unison acquisition? If you could give us a number out there. And what were the conversions and what are you factoring in?
See, Unison, we are selling around 1.3 lakh SCMD, and which is expected to grow around 10% this year on year. And in another 5 to 7 years, we expect that it will be around more than 1 million standard cubic meter per day. Regarding the conversions, we have clocked around 77,000 conversions this year. Last year, it was around 65,000. So there is a growth of around 12,000 vehicles. And some of the commercial vehicles have also come in the segment, which is the main driver for CNG volumes.
Okay. You have a big capex plan, right? Can you tell us how do you plan to fund this? I think 1,000 crores of capex is what you've planned for FY25. Would this put any pressure on your balance sheet? How do you plan to fund it?
Yeah, you are right. Around 750 to 800 crore will be the spent from Mahanagar Gas, and around 200 CR will be from the Unison Enviro. So around 1,000 CR will be the capex. The funding is from the internal generations, because this year also we have clocked a profit of around 1,290 crore. So barring out dividend payout and other things and adding the depreciation, we have internal generation available with us, which we will be funding the capex with.
Okay, so can you tell me what is the, are there any debt levels right now? And you said you will be generating cash internally. So can you just give us those numbers?
Right now we are a debt-free company, so we don't have any debt in our books. But we will be generating around 1,000 to 800, 900 crore of profit every year. So that will be funding the capex plan. Plus we have some cash reserves also available.
Mr. Shingal, just to go back to that first margin point, can we broadly say that margins, what you did in FY24, were kind of the peak? And then, this, I mean, you said 10 to 30 is a wide range, but roughly, I mean, that's it. That's the highest that you'll do, that MGL will do.
Yeah, I think we have to make a trade-off between volumes and margins. And also it depends on the alternate fuel cost and the cost of procurement, petrol, diesel prices. So we think that this is perhaps the peak which we have touched this financial year. And it is expected to come down going forward. And earlier also it was used to be in the range of 8 rupees, 9 rupees. And 9.5 rupees was the last financial year. This year it is 13.9 rupees. But we expect it to come down slightly in coming few years.
All right, Mr. Shingal, final question then before we let you go. I think in the last year you commissioned around 36 new CNG stations and you upgraded more than 40 stations. For FY25, what is the target?
In FY25, we have slightly more aggressive target, around 50 stations from Mahanagar Gas MGS side and around 25-30 stations in Unison. So collectively, we expect 75 to 80 stations, new stations in both the companies put together, and maybe upgradation of 30 stations in the this financial year.
Okay, all right. We'll leave it at that. Thank you so much for joining us, Mr. Shingal. So that's the word coming in from MGL. The market's actually trying to build on to its gains. There are plenty of stocks actually that are moving up with quite a bit of strength. Varun Beverages is up almost 3%. It has been a very strong stock this year. It's up almost 25% this year already. And today the stock is piling on the weight and the volumes. So there's price and volume action on Varun Beverages. Tata Power is the other one, up almost about 2.5%. There's no dearth of good ideas in this market. Definitely, despite all the volatility, there is plenty of buying action. As I was telling you, Havels is another one that's hit a fresh 52-week high today. Vedanta is also at a fresh 52-week high. And then a couple of other names also trending higher. Let's do one thing. Let's take a quick break. On the other side of the break, the management of Karur Vysya Bank will be joining in to talk about their Q4 earnings. Later, we'll connect with Shantanu Roy of BEML to put focus on their Q4 earnings as well. Stay tuned. B. Ramesh, welcome back to Bazaar Morning Call. Well, B. Ramesh Babu of Karur Vysya Bank is joining in now to talk about their numbers and the way forward. Sir, thank you so much for joining us. Appreciate your time here. I want to first start by, the top line growth, the NII growth, which was quite on the weaker side. Is the incremental cost of funds coming in at a higher rate than the incremental yield on advances? And I want to understand, going forward, is this weakness something that can continue on the NII front?
Yeah, good morning, Sonia. In fact, this financial year is one of the historic years for the bank because many of the key parameters under the business growth, asset quality and profitability, there are many parameters are decadal high. So now coming to the NII, what you mentioned, so it's pretty good. In fact, we have seen our NIM, which is at 4.19, so which is as per our expectations. So we have rebalanced the portfolio, and many of the corporates we have reduced it low yielding, and that we have moved into our commercial, which is a high yielding segment. So that way, while I agree with you, the cost of deposits is going up. Now what we see is it's more or less plateaued. And the next 3 to 6 months, if the liquidity is quite okay, so there may not be any need for us to increase the time deposit rates also. And a lot of flows are coming. If you can look at our time deposits growth is 21%. It is more or less in the last 10 years is the highest. So that way liquidity, depending upon the liquidity, the cost will go up. Otherwise, we are on a safe track.
Okay, so this net interest margins, right? Can you tell us what are the sustainable net interest margins going forward? You're sitting at about 4.2%. In FY25, where do you think your margins would be?
If the rate cut is not there, so maybe in the first 6 months, we can expect around 4. It will continue. So that should not be an issue. And provided the liquidity is also okay and there is no much need to hike the rates to get the deposits. If that is there, it will have some sort of a bearing. But whatever it is, even if those sort of eventualities come up also, so it may be between 3.8 to 4. Otherwise, we feel that around 4 we can sustain in the first half year.
All right. Hi, Mr. Babu. Good morning. So we take that point on the NIMs. What about loan growth? Could you tell us, since you have repositioned or rejigged your portfolio, as you mentioned, went a little bit slow on the corporate side. What is the overall loan growth that you're guiding for? And within retail, which segment are you more positive on?
Yeah, Ms. Nigel, in fact, if you look at it, our retail has picked up a lot. RAM, if you look at it, commercial is at 21% and retail is at 18% and agriculture is 17%. So all these three engines are doing pretty well. The question is whether we can feed the same amount of raw material what they require through liabilities. So if we can raise the CASA deposits accordingly, so loan growth should not be a problem at all. So that is the reason conservatively what we have guided is so minimum of 14%. Last year too we have guided a 14%, but finally we landed at 16 plus 2.5. What we have shed consciously on account of low yielding 1600 crores during this year, so it has come to 18.5. So that way now loan growth is not a big problem, provided if you have the proper texture and a mix of deposits.
Okay, give us a few more numbers then. We've got the loan growth, we've got the NIMs out of the way. What about guidance on the gross NPAs as well as credit costs for the coming fiscal?
Yeah, gross NPA and net NPA, if you look at it, so these are decadal low. And our SMA, that is DPD 30 plus, if you look at it, it is less than 300 crores on an advances portfolio of around 74,000 crores. So this consciously we have made a lot of effort through collections and follow-up, and this has come to the stage when our DPD itself is around 300 crores. We don't expect a great slippages from this. That is the reason what we thought our slippage ratio can be around 0.75, something like that. And our credit cost also can be 0.6 to 0.75. That way it can go up. And beyond that, we don't expect that there are any shocks will be there as far as asset quality is concerned.
Okay, no shocks in terms of asset quality. I'll come to the guidance in a bit, but on the gold loan front, I mean, overall loan growth was weak, but even on the gold loan side, you have been struggling a bit. What is the way forward and what kind of average growth can you do?
Struggling in the sense that what consciously we did, high value gold loans, whichever are there, we consciously shed them and we granularize those things also. And second thing also, we thought of looking at the LTV. So gold prices have gone up. Suddenly there is a crash in that. We should not be caught on the wrong foot. That is the reason we brought down. Now, if you can look at our LTV, it is around 67%. That way, though 75% RBI has permitted, we are a bit cautious on that, not growing aggressively, but still if you can look at it, lot of growth has come up in the jewel loan segment. We also diversified into other agricultural segments like MFI also we are doing, and other agri also direct agri we are doing. So that way we want to diversify our portfolio rather than totally concentrating on the jewel loan for the agri.
Okay. All right, sir, thank you for being with us and appreciate your comments here on the business and the way forward. All the best for the quarters to come. Let's do one thing, that is Karur Vysya Bank and the way forward. Just wanted to mention the Bank Nifty has now moved into the red, so don't lose sight of that. But the other stock in focus is BEML. The company has reported a good set of earnings for Q4. Their margin has expanded, the profit has expanded 65%, while the EBITDA has also seen a good growth. Their order book, though, has missed the FY24 guidance of 14,000 crores. So we have Shantanu Roy, who's the chairman and managing director of BEML, who's joining into this discussion now. Shantanu, thanks a lot for joining in. It was a good Q4. The revenues just about making it to double digits, and EBITDA growth was about 29%. Can you tell us this 24.5% EBITDA margins, right? Is it something that is sustainable in FY25? And is that something that you can build on to? Are there any triggers for a better operational performance in FY25?
Well, very good morning, and thank you very much for having me here. The EBITDA margin, the EBITDA growth that I had already mentioned in my earlier chats, that it will be a growth of around 200 basis points. So we have achieved the promised numbers. But yes, I won't say that this is going to happen every year, because again, we are in a capital goods industry. We are in an engineering company in manufacturing. So an EBITDA of 14 to 15% is quite healthy, I would say. So I don't see a similar EBITDA happening year after year, but yes, we will definitely improve upon the EBITDA margin by at least 100 basis points in the current financial year.
You're saying that the EBITDA margins at 24.5%, you're saying that in the current financial year, you will be sustainable above 25%, right? Fair enough? 100 basis points higher is what you're looking at.
Well, what I meant was that the yearly EBITDA, the overall EBITDA margin for the year 23-24, we have managed to keep it around 12%. A growth of around 200 basis points as compared to the last year's EBITDA, which was 9.9%.
Okay.
The guidance that I have in my mind is a further growth of around 100 basis points over this 12% EBITDA annually.
So,
Okay. So 13%, right, Mr. Roy?
Yeah.
Okay.
It should be,
all right.
should be around 13%, which I feel is fairly, which should be fairly good.
No, absolutely. Good morning, Prashant here, and congratulations for a strong set. And you've certainly revitalized the company, and there is a sense of excitement with results, and of course, investors are looking forward to what you can do further. What about top-line growth? What should we expect in 25?
Top line growth, I will maintain it at around 18 to 20% CAGR for 24-25 as well as the coming years as well. Yes, we just barely managed the top line growth of around 4% in the last year, but there were certain reasons for that. And one of the major reasons was the challenge on the supply chain, challenge on the material, which was beyond our control because of various geopolitical happenings. But in spite of that, we managed to have a growth, we managed to have a improved bottom line with a focus on maximizing the shareholder return, the stakeholder return. And I'm very happy to share that for the first time in the history of BEML, we have announced a dividend of 205%. It has always been around 100%. So that is a major positive from the last financial year. Apart from, of course, the growth in EBITDA and, of course, the diversification and further consolidation and restructuring of the company that we have undertaken, and which is going to pay dividends in the coming years.
all right. Hi, good morning, Mr. Roy, and good to see you. And as always, congratulations to you as well as the entire team. I believe that BEML has completed 60 years over the weekend. So good going, and wish you all the best. Now, we've got a couple of details out of the way. 18 to 20% revenue growth, margins at around 13% odd. Break it up for us sectorally. How much of growth do you see coming in from the railways, defense, and mining? And what could be the rough revenue mix for FY25?
Good morning, Nigel. Thank you very much. Yes, it is indeed a very momentous and joyous occasion for us on completing 60 years of the existence of BEML. The 60th year foundation day celebrations were a mega event. And before I move on to the guidance for 24-25 sector-wise, let me talk about the numbers, the contribution sector-wise in the 23-24 numbers. So we have seen a huge spurt in the contribution of rail metro vertical to the top line. Last year, it contributed 27% to the top line. This year, rail metro has contributed 38%. Mining has gone down to around 43% from the 50%, which is going to be the scenario in the next, in the coming few years as well. However, the major challenge came in the defense vertical, wherein even though we had the orders, but because of execution challenges, defense could contribute only around 19% to the top line of the company. For 24-25, again, my guidance will be mining, defense and rail and metro should put together contribute around 60%. The number is around 57% put together for both of them in 23-24. It will go up to at least 60%. Mining should be around 40%. And that is going to be the trend. I believe somewhere along the line, during the coming years, we will be having a contribution of around 65% from defense and rail and metro, and mining will stabilize at around 35%. Of course, the volumes will also go on increasing. The total numbers that we have planned for the top line, they will also go on increasing in absolute terms.
Okay, got it. Now, given that we are in an election year, do you see some headwinds on the order inflows? What can you guide for FY25 in terms of order inflows? And if you could break it up for us sectorally. At the end of the year, what kind of an order inflow number should it be looking like?
I was expecting this because Sonia had earlier mentioned that, we missed the guidance of 14,000 crore. So I don't know whether it's because of the election year or not, but yes, there was some more tenders which were deferred, especially in the metro and the rail sector, where around 3,000 crores of orders were deferred, which will now happen sometime between June and September. So that was one of the reasons we missed the guidance of 14,000 crore. For the year 24-25, as I mentioned the last time, the opportunity size for defense in our core capabilities is around 6,000 crore. For the rail and metro put together, it's around 58,000 crore, and mining, the opportunity size that we can see at present is around 3,000 crore. So that will be the opportunity size for us. And the order book guidance, well, if we have a hit rate of 50% for the rail and metro and for defense aerospace, and if we can have a hit rate of 80% for the mining, anything between 20,000 to 30,000 crore to end the year with will be a decent number for us.
This MOU that you signed with BEL, right, to develop this indigenous train control systems, can you tell us a little bit about it? What is the kind of timeline that you're looking at? What is the key rationale behind this? What can it contribute to your business?
The TCMS, or the Train Control Management System, is one of the backbone for any unmanned train operation. It has a onboard hardware as well as it has a software part. And it's a part of the propulsion, and along with the propulsion, it basically controls the train movement. Wherein a direct communication is set up between the train, the signaling, and the central command center. India has a very typical requirement for a metro, where the TCMS is a dual homing system. In all the metro tenders, the future, it's all grade of automation 4. And there is no Indian TCMS which is available at present. We are dependent on the foreign OEMs who generally keep TCMS as a part of the propulsion. So it is one of the major steps towards Make in India and Atmanirbharta in metro automation that we entered into this MOU with Bharat Electronics for developing a TCMS which will serve the country for the future years in grade of automation 4, achieving grade of automation 4. And the timeline that we have in mind is somewhere between 12 to 18 months.
Oh, so 12 to 18 months for this MOU. So can you quantify it for us, this TCMS opportunity? What could it mean? I'm sure you haven't factored it into your guidance right now, correct? Or just correct me if I'm wrong. What kind of monetary opportunity do you see because of this?
Well, the guidance that I have just given, it also has TCMS, but it will not be the indigenous TCMS. The indigenous TCMS, when it comes into play, because it is, once we develop, it has to undergo validation, it has to undergo extensive trials. So the entire thing may take, that's why I said 12 months to 18 months. Once it is done, then of course, every year we see a growth in the metro. So if we annualize, the annual metro rolling stock guidance is around, I'll put it at around 2,000 to 2,500 crores. That is an average. And that is the kind of opportunity size that we can see in the future. Not only this, in the commuter rail, also we have a TCMS. We can further tweak the TCMS for the metro, which is much more stringent, to the commuter rail segment as well.
Okay, so 2,000 to 2,500 crores of an opportunity is what you said, right? Annually, I assume.
It is the rolling stock opportunity. TCMS is
the rolling stock opportunity. Okay, got that.
Integral and important and critical part of the rolling stock.
Got it. Any other opportunities from the government's end? I mean, what kind of impetus are we seeing from the government on spending both on rail infra and defense capex? What is the incremental opportunity that you see for a company like BEML?
You see, the opportunity size is huge, as I mentioned. Rail, it is not only the various rail-borne maintenance vehicles or the rail grinding machines, basically the track machines, but also the Vande Bharat passenger trains and the semi-high-speed trains. So the opportunity size is huge. As far as defense is concerned, our focus is very much on the engine and the power pack. And apart from the engine and power pack, we are also focusing on the combat vehicles, on the combat engineering vehicles, which is the future requirement of the Indian Armed Forces, along with the mainline combat vehicles for the Indian Armed Forces. We also have taken a route of diversification, and in our endeavor for diversification, we have just set up a strategic business unit of aerospace, wherein we see a huge growth in the coming years. And apart from the aerospace, we have two micro SBUs, which will be under the aerospace. And one of them is the maritime. The maritime and naval systems presents a huge opportunity to a company like BEML. And it is one of our main focus diversification areas. As far as the investments are concerned, we have already undertaken a path of investments, of capital investments. This year, we have planned a capex, which is around roughly around 8 to 9% of our last year's revenue numbers. And this is mainly focused towards enhancing our defense manufacturing capabilities, our engine manufacturing capabilities, and our rolling stock manufacturing capabilities.
All right, just want to clear the air, sir. On the order book, currently it's 12,000 crores. You said you'll end the year at what?
I said somewhere between 20,000 to 30,000 crores.
20,000. That's a broad range, but we'll hold you at that number, 20 to 30,000. Maybe as the year progresses, we can narrow down on that number. And finally, have you heard anything with regard to progress in the divestment of the company?
That's one of the most difficult questions, that you always put across, Nigel.
But we want to know about it, sir. If there is any kind of movement, have you heard something?
No, we have not heard, and Deepam is the right agency to answer that question, Nigel. My job is to ensure that the company remains on the path of growth, and we grow at a CAGR of 18 to 20%, and we keep on giving more dividend to our stakeholders.
Okay, we'll hold you at that, Mr. Roy. Always good seeing you in. A revenue growth of 18 to 20%, margins at around 13%, order book by the end of the year at around 20 to around 30,000 crores. Wish you all the best for the remainder of this year, and we'll keep chatting with you as the year does progress.
Thank you very much.
Well, for the time being, let's get Mitesh back. Well, Mitesh, it's that sort of a session where we're holding our ground at least. The Nifty Bank, though, that's the one that's underperforming. But yesterday, out of nowhere, we saw a big short covering bounce that did play out. Levels you're tracking in on the Nifty Bank in particular, and your stock picks as well?
Yeah. So, Nigel, yesterday, I was talking about the bounce back and said that it could go to possibly 22,200, and if we cross that, then we'll turn slightly positive. And in fact, we got a high of 22,180. So right there, and it's failed to do that. So it looks like we are still, in some kind of a range movement consolidation with a mild negative bias. If we get a closing about 22,200, it'll change things. But for the timing, it is 22,200 to about 21,800 as the broader range on the Nifty index.
Okay, what about individual stocks?
Yeah. So I have a buy on Colgate, on Dower with a stop at about 548 and a target of 575 can be looked at. And the other one is a sell on Dixon with a stop just above levels of 8250 for targets of 7900.
Okay, thanks, Mitesh, for that. Well, let's slip into a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Stay tuned. Okay, well, for now, the market is very, very quiet. I don't know if it's the lull before the storm, but for now, there's really no action there. Gives us some time to look at what's happening in the commodity markets this morning. Manisha Gupta, our commodities editor, is joining in. Manisha, what's the one commodity you're tracking today?
I'm looking at the metal prices as a sector because we've seen prices continue to trade firm here. If April was anything to go by, well, May only seems to be building up on those kind of gains. So when you look at overall as a sector, there are supply concerns from mines and smelters, and then there are delayed shipments and higher freight rates. All of that seems to be keeping the prices on the higher side. And also when you look at the numbers, the immediate demand isn't so strong because you're looking at discounts for immediate delivery, but the long-term demand seems bullish, and the markets have done their calculations because when you look at the kind of supplies coming in for the next 3 or 5 years, you don't have the demand catching up on that sense because you have stronger numbers in that market there. Also, it has been about the strong fund money which seems to be chasing many of these commodities that is keeping the prices supportive. China has rolled out supportive measures for its property sector that has taken the prices higher in China also. And then if you look at the China trade data, we've seen export and import, both those numbers on the positive side. It also has been the high mining cost, and that is the reason we have seen those M&A activities being proposed rather than starting new projects, and that would keep the markets quite chatty in there. Also, markets are looking at higher multi-month highs for many of these commodities. So copper is trading at near 2-year highs. There are bullish long-term demands there, not just from the conservative sector, but also from AI and data centers and EV and etc. And with this additional incremental demand that copper is looking at, the supplies clearly do not seem to be matching there. Also, when you look at the prices itself, we saw nearly 15% of gains in copper prices for the month of April, and May has seen nearly 7% of a jump up since then. Also, when you look at the New York or the US copper prices, they are at a $300 per ton premium over LME. So we are looking at stronger demand continuing from US also. If you look at the CME copper inventories, well, we have seen a 30% of a decline into that one in a matter of last 1 month, supporting prices. Not just copper, you have lead, which is trading at a 24-week highs. Well, the prices here have gained 4% in the last 1 month. Zinc is the other one that should come in on your screens because we've seen prices gain up to a 13-month highs onto this one as well. 7.5% of gains in past month is what zinc also has put out. Tin is trading at a 2-year highs, and we've seen 30% of price gain happen in 2024 till time. If you look at the tin inventories, well, we've seen a decline of 40% into that one in this year, and we're just about holding at around 4,400 tons into this one. There are supply concerns coming in from Indonesia, Philippines and Myanmar, keeping tin prices where they are. Well, going forward, it's going to be all about the US inflation data. Well, CPI comes in today, PPI tomorrow. That is what will tell you on where the metal prices will take the near-term direction from.
Okay, thanks a lot, Manisha, for that. Let's do one thing. Let's slip into a quick break. On the other side, we'll get chatting with Devdatta Chand of Bank of Baroda on their Q4 earnings and what the state of the PSU banking sector is in.
Welcome back. Well, as we speak, actually, the markets have moved into the red. We were trading in the green. The Nifty Bank is the spot of bother. That one's down close to around 80 points approximately. But a couple of names from the frontline index itself are doing well. Shriram Finance is the one that's holding up well in the green. Abhishek joins us to run us through a quick analysis on that stake sale that they did yesterday. Abhishek?
Well, Shriram Finance has sold their stake in Shriram Housing Finance. The transaction is worth about 4,630 crores. So, Mango Crest Investment Limited, which is an affiliate of Warburg Pincus, will purchase the stake from Valiant Partners, who owns about nearly 14.8%, and from Shriram Finance as well, who own about 83.8%. So, some of the key financials of Shriram Housing Finance is that the AUM is about 13,762 crores as of FY24. They had a gross NPA of 1% and net NPA of 0.8%, and their capital adequacy ratio is strong at 25%. Back to you.
Okay, in fact, we have the management joining us in a short while from now, so we'll get chatting with them about the way forward. But Upasna is joining in. She's tracking HAL and Cochin Shipyard. Upasna, over to you.
Well, UBS has given a buy rating on HAL and also increased the target price from 3,600 to 5,200. It has forecasted a threefold increase in HAL's order book, and 25% revenue growth is what they are factoring in manufacturing top line from FY23 to FY27. Well, the brokerage says that this would be led by mainly a pickup in large military orders due to depleting fleet, a robust supply chain and a ready capacity of the company. It expects the order win of the company of almost 5.3 lakh crore over FY24 to FY28, implying a quadrupling of the order book by FY28 is what the brokerage just said. It has also raised its EPS forecast by 4 to 11% for FY25 to FY27. Now, coming to Cochin Shipyard, the company has secured order in the range of 500 to 1,000 crores from a European client for mainly construction of a hybrid service operation vessel, and this project is expected to be completed by the end of 2026 is the reason why Cochin Shipyard will also remain in focus today.
Thanks a lot for that, Upasna. And let's wind this down with Mangalam then. He's here to tell us about Ethos. Mangalam, it's that sort of a market. Headlines not moving much, but good results. They're being rewarded. Tell us more.
Nothing quite sells like luxury, Nigel, does it? I mean, Ethos, good numbers coming in, 22% revenue growth, reflecting in 40% growth in the EBITDA, and the net profit for the company has grown 58%. But these were numbers that were reported to the exchanges. Post-market close, the company reported its presentation, and there the internals were pretty heartening. The average selling price per watch has actually jumped from 0.84 lakh in FY20 to about 1.9 lakh in 2024. So that's the jump that we've seen more than 2 times in just 4 years. Share of luxury watches in their revenue also increased from 48% to about 68%. Other internals as well, pretty strong. Second and pre-owned watches grew about 27% in FY24. They added 5 new exclusive brands and 10 new stores in the last year as well. And going forward, they have laid the triggers out, expanding their physical store network, adding more watch brands to their overall collection, growing pre-owned luxury watch brand business as well. But now that they've created a pool of luxury customers, they will expand that, leverage that beyond watches and sell luxury jewelry along with luxury luggage as well. So, I mean, all things premium doing extremely well.
Okay, all things premium doing pretty well. Thanks a lot for that. Well, for the market, as we were saying, there was a little bit of a lull, but now it's sort of dipping into the red. All 4 indices are in the red, not by a huge amount, but just look at that slow and steady grind to the bottom now. So do things get worse from here? You never know, but right now the trend is not looking good. Polycab is down about 2%. UPL is down quite a bit, actually, the biggest loser on the index. The biggest loser actually right now, 5% I think lower on UPL, and Cipla is down about 2.5%. Okay, let's focus on Bank of Baroda, because the bank came out with their numbers. The business momentum was strong, loan growth is healthy, gross NPAs is the lowest that we've seen in 36 quarters. Devdatta Chand, who's the MD and CEO of Bank of Baroda, joins us now to discuss their Q4 performance and the business outlook. Mr. Chand, good morning and thank you for speaking to us. First, I wanted to talk a little bit about the loan growth momentum and what you expect could be the full year, loan growth target for FY25, and how do you see corporate loan growth going ahead?
Yeah, thank you very much. So good morning. We said that the guidance for the full year is around 12 to 14%. And if you see the loan growth of Bank of Baroda, particularly for last couple of years, the growth is quite strong. At the same time, we are focusing more on the retailizing the book in terms of the growth in retail has to be faster than the normal. At the same time, the corporate book is also quite robust. We had given almost a 11% growth this year. And going forward also, I believe that the growth would continue in the same.
Okay. So corporate growth is quite robust, you said, and an overall 12 to 14% loan growth guidance for FY25. But I want to know a little bit about SME and the agri portfolio, because, we're getting a mixed picture from some of the other bankers. We hear that the agri portfolio continues to be under pressure, especially in some rural pockets. Your own growth has been a bit slower compared to other pockets. Are you facing pressure there? And on an average, what would the growth be?
See, the growth in both that agri and MSME, somewhere we're growing at 12 to 13%, and something again for this year we try to optimize that. And we're targeting at least to grow 1 or 2% higher than the last year growth, both on agri and MSME. The reason being on the agri, we are now segmenting the agri and we're targeting also the creamy layer of the agri. At the same time, MSME, we are focusing hugely in terms of having the customer cash flow, at the same time trying to have products which can match to the customer cash flow. So there are different strategies for agri and MSME this year, and I think that as you are targeting to grow slightly 1 or 2% higher than the last year, we'll be in a position to do that both in agri and MSME.
All right. Hi, Mr. Chand. Good morning and good to see you. And one point that the street didn't like in these numbers on Friday was the slippages number. So give us some clarity on that. Which segment did contribute to this rise in slippages? Is it seasonal? And what could the recoveries be from these slippages? Give us an outlook for FY25.
Yeah, if you look at the slippage ratio has been better than the last year. We are at 0.99. At the same time, the provision which you are seeing this year vis-a-vis the last year, precisely because of one account, which we have fully provided in, that's aviation account, we talked earlier also, which we have fully provided this year, leading to slightly an increase vis-a-vis last year. But as far as if you look at the GNPA and net NPA, everything is trending downwards from many quarters now. And we are also quite hopeful that going forward, we'll be maintaining this trend both in terms of GNPA and net NPA. Secondly, the account where we have made 100% provision, I think substantial upside in terms of recovery going forward, because that account is highly collateralized. So we're giving a guidance of around 10,000 crore of recovery this year. We had a guidance of 12,000 crore of recovery last year. And we have rather exceeded our guidance in terms of the recovery for the full year FY23-24. And I'm quite hopeful that this year also will be in a position to achieve the target. Rather, as far as GNPA and net NPA is concerned, we are almost like GNPA less than 3. And although we are not giving a guidance, but we'll be trending towards 2.5 GNPA and 0.5 towards net NPA.
Okay. Can you tell us, now that your app Bob World, the restrictions have been lifted on that from the RBI, will that incrementally help you with your deposits and advances growth going ahead? Just trying to understand how, that kind of relief that you've gotten from the RBI restrictions, will that sort of help you with your deposit growth?
So definitely, if you look at, even if when the ban was there, we could optimize on the deposit. Rather, the impact of the ban is on the retail CASA, retail saving fund account. And if you look at my growth, I'm almost aligned or higher than the market in terms of the growth in saving. So definitely going forward, we are targeting a much higher focus in the CASA, particularly on the retail saving. And if you look at my CASA growth in last quarter, it is better than the full year growth. So there is traction on the CASA, and this particular event of the ban getting revoked, it would definitely help us to optimize that. And this year, again, we are targeting a deposit growth of 10 to 12%. Out of that, main focus would be on the CASA and the retail term deposit. And definitely, this is going to help us more on this.
Okay, got that. I wanted your thoughts on the provisioning norms on project finance that the RBI has put. What is the likely impact on a bank like yours?
See, as far as the guidelines is concerned, it is more of a consultative process and also a draft guidelines. So we are evaluating the impact of that, but I don't think the impact can be a couple of basis points on the credit cost. It may around 7-8 BPS maximum, but we'll give a comment once the final guidelines is issued on the matter. Till that time, we have no comments to offer as far as this guidelines is concerned.
Okay, so no major impact is what we can assume, right?
Yeah.
Got that. Okay. What about the India First Insurance, that IPO? I mean, it never came despite you appointing bankers. Any kind of timeline that you're looking at for the IPO to hit the street?
So there is no timelines, but as far as the process is there, we are still into it. Like as far as divestment is concerned, we'll be again divesting that. But everything would depend upon the market condition and the timing therein. The time could not do that because the market condition was slightly insurance sector, or the prices were not that, valuation was not that attractive. So all would depend upon the valuation and the right timing. And once that is there, we'll be there to upload that.
Do you think sometime of this year it will be possible, coming fiscal?
It can be. All would depend upon the valuation at which I can divest my stake, right? So that's absolutely a market determinant rather than any particular timeline. So if there is an opportunity this year, definitely we'll be again doing that this year.
You have given us most numbers then about this divestment. You intend to do it. You'll have to wait by for the timelines, the loan growth, the sectors that are going to grow, as well as asset quality. What about NIMs? What should that number look like?
NIM, yeah, absolutely. The NIM, as far as the full year NIM is concerned, we had given a guidance of 3.15 plus minus 5 BPS. And the full year NIM is higher than that, actually at 3.18. If you look at the last quarter NIM, it is better than the December quarter NIM. So we are able to manage the asset liability profile so as to maintain the margin part. And going forward also, we are giving the same guidance of 3.15 plus minus 5 BPS. And as far as the current scenario is concerned, the outlook is concerned, I am looking at maybe the rate would continue to be higher for longer, but the liquidity part, I think, would moderate as compared to the last year. A scenario like that, I think we'll be in a position to maintain our margin for this year going forward and continue to have the guidance of 3.15 plus minus 5 BPS.
Okay. All right. We will let you go on that note. Thank you so much for joining us and speaking to us on CNBC-TV18. Appreciate your time here. By the way, for the market, just before we wind down, a couple of stocks that deserve mention. The auto stocks are picking up pace right now. Hero MotoCorp, M&M, both up about 2% or so. Maruti Suzuki up almost about 1%. And then a couple of other names, Eicher Motors also in the green. So this is one pocket that's looking pretty good. And overall, you'd have to say, although the market is very quiet, just extremely flat, there are plenty of pockets that are picking up pace.
Well, that's right. Let's run you through the numbers of JSPL. As we mentioned earlier, those numbers look quite good. And the EBITDA number was better than expected. You know, the consolidated number that we were working with, it was a 100 crore beat in comparison to what we were working with. How was that possible? The standalone EBITDA per ton, well, it came in closer to around 12,500 rupees per ton, which was better than around 12,100 that we were working with. One of the key factors out there was volumes were better. So on a sequential basis, there was a growth on the volumes. It came in at around 2 million tons. We were working with a number of around 1.9 million tons. How was that possible? Exports as a percentage of their mix, well, it contributed close to around 11%. In quarter 3, the number was at around 3%. So operating leverage played out, and that's what helped them out in terms of delivering better numbers. The debt number moves up, but that's par for the course because they have a big capex that's underway. They're looking to move to around 15 million tons from around 9 million tons. So that's the reason that the debt moved up. Now, quarter 4, as I told you, the numbers were better than expected. And quarter 1 could even be better, particularly in the EBITDA per ton moving from around 12,500, it could move northwards. Why is that? Few factors that should come up for you on the screen. Steel prices are high by around 1,000 rupees per ton. The management expects to push through a couple of price increases. The coking coal cost, well, that is likely to come down by around $30 to $40 per ton because the international coking coal prices have come down. And also thermal coal they're getting from their captive sources. So that will result in some savings as well. And finally, they were selling some semis, around 1.4 million tons for the past year. Now they'll be converting those semis into value-added products, so obviously you get better realizations. So put all these factors together, the outlook as well from here on is good. And that's why the stock is holding up well in the green. Well, that's about JSPL. Let's talk about Aarti Pharma. Ekta joins us to run us through a quick analysis on that. Ekta, the stock's flying away.
Well, yes, it's a good operational performance which has come through for Aarti Pharma this time. So the revenue is up around 4% on a year-on-year basis. What has stood out is the operational performance. EBITDA around 117 crores, which translates into a margin of 23% versus 16% year-on-year, and a profit of 65 crores versus 43 crores year-on-year. Q-on-Q as well, the EBITDA has looked good for the company. So EBITDA is at around 117 crores versus 95.7 crores Q-on-Q. Margins improving to 23% versus 21%. So overall good performance. Operational beat is what stands out for the company this time.
Okay, thanks for that. Well, we're going to wrap up this market saying that the advanced decline ratio, the market breadth is very healthy. at 1,600 stocks on the advancing side. Apart from that, it is a very, very quiet start to trade, so not too much happening. But yes, there are some pockets which are doing quite well. Metals, autos are still standing out. And there are plenty of stocks which are sitting at fresh 52-week highs. Aarti Pharma is one such stock, 9% higher at a fresh 52-week high. Hindustan Aeronautics is at a fresh 52-week high. JSPL, Vedanta, Jupiter Wagons, a stock that has come on the radar. It's up 60% this year already. Jupiter Wagons, a big mover over there. It's at a fresh 52-week high, and names like, usual suspects, usual favorites like Polycab, Havels, all Siemens, all sitting at fresh 52-week highs as well. With that, it's curtains down on Bazaar. Thanks a lot for watching, but Chartbusters comes up next.